Navitas stock is trading around $6.17 after climbing 165% over the last year. So the real question is, was that rally a fluke, or is this company about to prove everyone wrong? Well, here's what I know. Navitas makes gallium nitride chips, the kind that charge your laptops or EVs 3 times faster in half the size and up to 40% more efficiently than old school silicon. Their clients, Dell, Lenovo, NVIDIA, Xiaomi, that's big tech trust you can't fake. But here's the problem. Revenue just fell 29% year over year, losses doubled, and the next quarter looks terrible. That's not growth, that's collapse. And investors are already nervous after their CEO stepped down. Now, here's what I'm watching that I think almost nobody's talking about. Data centers. AI demand is expected to triple power usage in the next decade, and water consumption is a hidden crisis. If Navitas chips really cut costs and boost efficiency, this isn't just a tech play. It's an ESG play that could unlock massive contracts. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/RickO to get your 10 stock picks right now. In this video, I'm going to be breaking down whether Navitas is a buy, hold, or a stock that you should run away from. My name is Rick Orford. I've been trading since 1999, and I am not a financial advisor. That is a good thing. I don't sell hype, and I don't push products. I break down the numbers so retail investors like us can make smarter, more confident decisions with our money. So, is Navitas the picks and shovels play for the AI era, or a ticking time bomb? Let's find out. Navitas is a pure power semiconductor company that was founded in 2014. The company makes gallium nitride, or GaN, and silicon carbide, or SiC-based technology for electric vehicles, mobile phones, solar panels, and data centers. And here's why you need to care right now. Semiconductors aren't just another industry. They're the backbone of every megatrend that's happening right now. And Navitas is betting on being the picks and shovels supplier for that growth. In 2016, Navitas debuted their first gallium nitride-based power integrated circuit, or IC, one of the world's first ICs to fully integrate key functions and components into a single monolithic chip. And why does it matter? Because the game has changed with GaN. GaN-based power ICs have faster switching speeds and lower on resistance, which results in higher efficiency and lower temperatures. They also take up less space since they're in one piece. And the result? Faster charging for things like your laptop, cell phone, or even your EV. One of the most well-known GaN-based power ICs from Navitas is their GaN Fast Power IC, which is reported to charge 3 times faster in half the size and weight of traditional silicon-based chips, with up to 40% better power efficiency. These power ICs are used in mobile chargers, laptop chargers, data center power supplies, solar inverters, and EVs. Today, Navitas's clients include Dell, Lenovo, NVIDIA, and Xiaomi, and that's proof that they already earned the trust of big tech. And in semiconductors, trust equals contracts, and contracts equal revenue. Now that that's out of the way, let's get into the juicy parts, starting with the company's stock price, because ultimately, that's what we're here for, right? And can you actually make money on the stock? By the way, if you want to follow along, just scan this QR code. Last time I reviewed Navitas was in late August when the stock was trading around $6.40. Since then, prices have dropped slightly as the stock now trades around $6.17. This drop happened following a change in Navitas's leadership as Gene Sheridan stepped down as CEO and was replaced by Chris Alexandre. And I'll talk more about that later. That kind of drop tells you just one thing. Investors are not confident in the newly minted CEO. And it also didn't help that Gene Sheridan announced his successor just a week before he stepped down. Because when leadership changes feel rushed, Wall Street gets spooked. Still, the stock is trading higher than it was a year ago. Year to date, it's up about 72%, and over the last year, it's up 165%. So even with the pullback, long-term holders are still sitting on big gains. So Navitas was on a pretty upward trajectory before the financials, but then the change in leadership was announced, and things got a little bit hairy. But the trajectory only matters if the fundamentals can back it up. So let's dig into those numbers. According to their second quarter financials, Navitas revenue dropped 29% from $20.5 million to $14.5 million. Net losses also more than doubled from 12 cents a share to 25 cents a share. That's not exactly encouraging news for shareholders. Losses accelerating while revenue is shrinking, well, that becomes a double hit. Meanwhile, third quarter guidance puts revenue around $10 million. For reference, the third quarter of 2024 revenue then came in around $21.6 million. So if it's true, that'll represent a 54% drop year over year. That's brutal, because when revenue collapses that fast, the real question becomes, what is management not telling us? Although Navitas has been earning less this year compared to last year, several factors could still drive growth in coming years. And here's where it starts to get interesting, because this is the part of the story that I think many investors are overlooking. The company's GaN chips don't just mean happier retail customers, right? They also lessen the environmental impact of data centers, which we've recently discussed in my Discord channel. Data centers' electricity demand is expected to grow 300% over the next decade. It's not a forecast. That's a tidal wave of demand. And while AI companies are going nuclear to address that problem, it still doesn't solve their water consumption. Data centers consume a lot of water, with the larger ones estimated to use up to 5 million gallons a day. With Navitas's technology, data centers and other mass-scale computational facilities can achieve higher power efficiency, which in turn reduces their electricity and water consumption. Plus, it also overhauls their overall carbon footprint. For most companies today, that is a double benefit. They get reduced costs, more funds for improvement, and of course, don't forget the improved ESG scores, which can be key factors when attracting investors. When you can save money and boost ESG scores, you're not just selling chips anymore. Now you're selling reputation. And that's priceless in today's market. So you could say that Navitas isn't just in the semiconductor business, now they're in the credibility business. On August 25th, Navitas named Chris Alexandre their new president and CEO. Chris is a seasoned veteran with over 25 years of experience in the industry. With his numerous achievements and extensive experience, as outlined in his resume, Chris appears to be well suited to the task. But of course, time will tell. New leadership can either be a spark or a landmine. The government is also continuing the National Electric Vehicle Infrastructure Program. This program is part of the Infrastructure Investment and Jobs Act that allocated $5 billion to create a national network of EV chargers. The $5 billion is going to be split among the individual states based on a formula, and each state will then build EV chargers at their discretion. So why am I talking about this? Well, Navitas could gain here on two fronts. One, its GaN technology could be used to make EV chargers. Two, if EV chargers are more accessible, it could also drive up EV sales. Also, while Navitas is not a solar or EV company, many of its clients are. In fact, Navitas's technology is used in EV products from batteries, converters, and traction drives. So Navitas doesn't need to sell EVs themselves. They just need the EV industry to keep growing. And right now, the government is literally funding that growth. Of course, not everything is smooth sailing for Navitas. There are some risks involved, and here's where investors kind of get blindsided. The biggest red flag that I see, of course, is its declining revenue. Here's a quick look at the company's sales in the last 5 quarters. Meanwhile, losses, they're also increasing, which is never a good sign. And while Navitas has discussed their pivot to AI power infrastructure and, of course, the tariffs that they have to pay for importing goods from China, their third quarter expectations are still very weak. The outlook suggests that management is tempering expectations despite the AI narrative. In other words, they're telling you to keep your hopes in check. As it stands, I'd like to see better signs of revenue stabilization, or at least a clear path to that goal before I mark this risk off my analysis. Navitas is also taking a hit from the removal of tax credits for the solar and EV industries. So how do EV and green energy issues affect Navitas? Well, sure, the company is not a solar or EV company, but as I said, many of their clients are. In fact, Navitas powers many solar and EV products with their GaN ICs. For example, Enphase, a solar energy company, uses Navitas' technology to power its solar microinverters. And then we have BR USA, a company that develops power electronics for electric vehicles. They produce onboard chargers and DC to DC converters, all using Navitas' GaN power ICs. With the removal of tax credits, demands from EV and solar manufacturers, well, they're going to slump, and consumers may be less willing to buy solar and EV products. And when your customers pull back, it doesn't matter how good your tech is, revenue is going to take a hit. For Navitas, analyst ratings have also been steadily decreasing, which translate to the lower side of a moderate buy rating. I think it should be a hold. Don't get me wrong, Navitas' tech is very cool and has a lot of potential to save their customers money. However, the macroeconomic environment, the factors, and worsening top-line numbers are creating just too much risk and uncertainty for me to suggest a buy rating. Of course, if you believe in Navitas, you can allocate a small portion of your risk capital. You never know. I just wouldn't bet the farm on them because there's far more quality names out there. So you could say that Navitas is a watch list stock, not a portfolio cornerstone. But what's your take? Are you buying, holding, or letting go of your shares? Let me know in the comments below. And while you're there, don't forget to like and subscribe so others will find this as well. Well, folks, that's it for me today. I wanted to thank you so much for watching this video, and I'll see you next time.